Hey, this is Dominic Longcar, the entrepreneur in residence at Futurepreneur Canada. I'm here to take you through part 3 of our video series. In this section, we'll look at cash outflow, expenditures, and income statement, and I'll show you how everything ties together. Open the tab Cash Flow Year 1. We are now looking at cash outflow. In step 4, you'll notice inventory costs. In our example with Amar's protein shake, he will at some point need to reorder inventory. However, he's also free to use the percentage of sales cost. So if he buys inventory on a monthly basis, then this percentage could be helpful. So he would put in, for example, 20%, and it would automatically populate the cells. However, for his particular case, that's not true, because he probably won't order until much later, and in this example, until May. However, this can be quite useful for those businesses that are restaurants or cafes where they reorder automatically every month, and they would use this percentage. Step 5, general expenses. Keep in mind that for the next 24 months, you are looking at your expenditures, and you have various cells that you can use as you see fit. You can take subcontractor, you can take legal fees, you can substitute other expenses instead of those, so you have wiggle room to change those cells. However, one particular cell you can't change is first owner's draw or salary. Those are cells that indicate when you plan on taking money out. So in our particular example here, Amar is taking money out in March for $1,000. Before then, he's not taking any money out as a living expense. So he has to count where he's getting that money from. In some cases, people move in with their spouse, they have part-time job. Every entrepreneur is different, but it's important to realize that the purpose of doing this cash flow is to realize at what point are you making money that you can live off of. The other thing to keep in mind you should take money out in this field in increments. In other words, it shouldn't go up and down like a yo-yo. You shouldn't have 1,000 one month, 6,000 another, and then 3,000 the other month. So keep this in increments. You'll also notice that there's another column called second owner's draw. So if you have a business partner, this is another column that you can fill. It's not necessary and not mandatory because the other partner may take a draw out later on in the year. Then you look at all the other expenses. Keep in mind that these expenses should be done month by month. And if you look at some of them, they'll be fixed. So for example, you'll have telephone and internet expenses that are fixed. They don't change. Other expenses are tied into your sales, which are really called variable expenses because they change depending on the amount of sales you have. You shall also see that there are some amounts of money in a particular column, such as accounting services. In this particular example, $300 in December. You need to explain what that's for. I would suspect that in this example, it's for his account when he does taxes. There's another column, for example, at the bottom called conference. And so he has $1,500 allocated for April, which is probably a conference he has planned to go to. Again, this needs to be accounted for in his business plan so that the numbers that he indicates here make sense. So when someone is picking up the business plan and the cash flow, they're in alignment. Keep in mind that what you cannot put in here is things such as your home rent, even if you use it for business, or your car if it's a combination for home and business. You'll be able to claim this later on in your taxes, but anything that's mixed for business and personal cannot go in your cash flow. This is strictly for 100% towards your business. You can also notice that if you go across your template here, at the other end of the spectrum, you can see that it adds up how much each expense is worth. So business insurance, $1,440. It's a good way to see what your expenses are for the year. In this particular example, their first year expense for owner's draw is $12,000. Step 6. Other disbursements. Notice that under other disbursements, the major cost here is total startup cost, $19,760 under November. This is the amount of money you requested that you need for startup costs back in the startup cost template. The difference between that and the actual loan that you requested, which is $30,000, that difference of roughly $10,240 is what we call working capital. So if you were to go back to your startup cost, you would actually see that amount listed there. That is money in reserve that you need to offset any costs that are incurred, because you may have a lot more expenditure than sales when you begin. You'll also notice that the interest rate is automatically populated here, both under the Futurepreneur loan funding and the BDC loan funding. And the principal is automatically populated. However, that doesn't kick in until year 2. The other thing you'll notice is that the total cash outflow, which is E, is $20,135. So what is happening? And again, this template automatically adds everything up. You don't have to do this. Is that Amar is estimating that the total amount of money leaving his wallet, his hands, for that month will be $20,135. And if we go back and we look at his inflow, which was $30,742, which is A, that is the difference that he's left for with that month, which is $10,607. That's a net cash flow. So you're always looking at money in, and then what's left over is your net cash flow. Step 7, cumulative cash flow. Cumulative cash flow is probably one of the most important pieces of the cash flow that you need to pay attention to. If you look at this example, in November, the cumulative cash flow is $10,607. That is what Amar's believes will be in his bank account or in his wallet for that month. At no point can any of those months, any 24 month under cumulative cash flow, be negative. If it's negative, he's done something wrong. And if you do this, you've done something wrong. So you have to keep in mind you have 3 choices. You either have to increase your sales, decrease your expenses, or a combination of the 2. The other thing you'll notice that's really important here is you can also double check to ensure that you understand what's happening here. And what's happening here is you're taking the total cash inflow, which in this case is $30,742, less the total cash outflow, which is $20,135. He is left with $10,607. On November 30th, he'll have that amount of money. He takes that amount of money and moves it forward to the next month. So you'll notice that in column H for November is the same for column G in December, because he's taking that amount and moving it forward. And so when you think about your cash flow, you're always moving it forward to the next month. Now, what you'll also notice is that there are some negatives. These negatives are allowed to happen under F, net cash flow. All that's saying is that for that particular month, that person plans to have a loss. Now, you can have a loss for the month, provided you have enough money in the bank account. So in this particular example, in December, he's accounting for a $430 loss. That means he'll have much more expenses than sales, $430. He needs to account for that or make up the difference. In this case, he can do that. However, he needs to be careful moving forward, because you'll notice in May of 2017, he has a big expenditure, which is inventory at $9,200. You'll also notice that for that month under F, $8,446 is estimated he's going to lose money for that month. However, because he has over $11,000, he can absorb the difference. So he's down to $2,600 roughly. What you need to be mindful as an entrepreneur when you're doing that, a danger zone is when your cumulative cash flow is less than $1,000. So when it starts to go below that, you should really look at your numbers carefully and be mindful that you want to get it to at least $1,000. At the other end of the extreme, some entrepreneurs in their cumulative cash flow have like $100,000 or a lot of money in there, which may mean that you're maybe not realistic in your sales, or you're not realistic in your expenses, and you're kind of undervaluating how many expenses you'll have. The purpose of a cash flow is to really look at the numbers month by month to see actually what will happen, what will unfold. Also keep in mind you do the same process for year 2. So you take the same expenditures and you'll click on year 2 and you'll see that the same applies there. Obviously, it's a bit more difficult to estimate expenses, so it's okay to have a certain percentage of increase to keep it as realistic as possible. One last thing is let's click on the income statement tab, and our income statement tab automatically calculates your profit and loss. You don't have to do anything. You just click on this and it'll show what the profit and loss is. In this particular example, you'll notice that in his first year he has a $10,000 loss, roughly $10,883, which is fine. When you're starting out a business, you may have that loss. As long as in the next year it's reduced or you start making a profit. In this particular case, because he's taking money out, more money out to live off, he has a loss. So again, don't be alarmed if you have a loss in your first or second year, as long as you're reducing that loss. That's the most important thing. That concludes the cash flow template tutorials. I'm glad you've come this far. I hope you found the videos useful. From time to time, review the videos. The more you do, the better you get. On behalf of Futurepreneur Canada, we wish you a successful entrepreneurial journey.